Hey, Dan Passarelli here. How are you feeling today? Today, we're going to talk about something near and dear to my heart. We are going to be talking about understanding the Greeks. In fact, we're talking about understanding the Greeks this whole, the whole month of March, actually. That's pretty exciting, isn't it? So today, we're going to focus on delta in the context of leverage and risk management. Now, I'd like to make sure you can hear me. Please go to the questions box and type the word delta if you can hear me. Please go to the questions box and type the word delta if you can hear me. Hey, what's up, Aslam? Bright-eyed and bushy-tailed. Maitel. Charles. Aditya. Thanks. Thomas. Thanks. Smith, thanks. William, thanks. All right. Newt, I hope I said that okay. Knut, I don't know. Patrick, thanks. Awesome, thank you. All right, now before we get started, I need to point out that options are not for everyone, and you should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Now, I see that there's some familiar friends here, which is great. And there's some names that I don't recognize as well. So allow myself to introduce myself. My name is Dan Passarelli, and I am an author. I am the author of the book Trading Option Greeks, actually. I just grabbed a screenshot from Amazon, a little pixelated, sorry about that. But this has been called the Bible of the Greeks. If you're interested in the Greeks, that is a great work to really get them super dialed in. And that is what allows me to be able to speak with you with some expertise on this. In addition to being an author, I'm also a trader. Been trading for a long time, over 30 years. And I'm the founder and president of Market Taker Mentoring, the global leader in option trader education. And I work with a lot of the good folks in the options industry, like Firstrade, for example, some other options brokers, a lot of options exchanges globally. And I'm a family man. Those of you who are a Market Taker student are familiar probably with my wife, Kathleen, who runs operations here at Market Taker. And I got my 2 adult children. And I do some things besides trading for fun. I'm a runner, a foodie, traveler, and I'm a music person as well. Now, for those of you who don't want to read a whole long book on the Greeks, I actually also have a quick reference guide. This is a lot shorter, doesn't nearly cover as much, but it's a great place to get started if you just want to get some of the Greek stuff down. And to get it, all you have to do is go to markettaker.com/QRG. That stands for Quick Reference Guide. So markettaker.com/QRG and grab this quick reference guide on the Greeks. All right, so let's talk about directional sensitivity. So here's the thing with options. There are a number of influences on their prices, like a stock or a future. You buy it, it goes up, you make money. It goes down, you lose money. You short it, it goes down, you make money. It goes up, you lose money. Pretty easy. It's all direction. Not quite so with the Greeks, but direction is a part of it, but it works a little bit differently from how stock prices work. If I am looking at a stock that goes up from 40 to 41, well, I know I made $1 per share. If I own 100 shares, I made $100. It's pretty simple. If I own the at the money call, at $2, 40 strike call, and the stock goes up $1, how much do I make? Actually, this is going to be like a fun little, I don't want to say trivia contest, but I would like to hear your thoughts. How much do you think I would make if I own the 40 strike call when the stock is at 40 and the stock goes up to 41? What would be the new value of my call? Tomas says 50 cents. So it would go up to 250. What do you folks think? Is Tomas the new Aslam of the group? Let's find out. Survey says 250. Yes. Nice work, Tomas. Nice work, nice work, nice work. There you go. And Newt, I like that. I like that. I like that. And correct me if I'm mispronouncing. Oh, Canute. Yeah, is that it? Yeah, what is the delta? That is it. That is it. What is the delta? Because at the money, okay, there you go. I was waiting for Aslam to jump in here because at the money is 50 delta. And, this is a little bit of an oversimplification, especially when interest rates are higher than zero like they are now. But, I'm going to go with this. It's a little oversimplified, but yes, that's the answer I was looking for. So great job, everybody. You guys are awesome. And Canute said, what is the delta? And that is what we're talking about here. Delta estimates how much an option's price will change relative to a change in the stock price. It is a measure of both leverage and protection. Now, in my book, Trading Option Greeks, I cover the 4 definitions of delta. So delta is, by textbook definition, number 1 is the textbook definition, the rate of change of an option value relative to a change in the underlying stock price. We could also use the mathematician's definition, the derivative of the graph of an option's value in relation to the stock price. So you got option value here, stock price on the horizontal axis. We're going to have a graph. And if we take the derivative, remember calculus? Who here remembers calculus? Who even took calculus? I had to take calculus. I was very nervous about calculus because when I was in high school, I was in my algebra class, I just played poker the whole time. I never, I didn't pay close enough attention to class, but I made a lot of money. And the problem there is that when I went to college, I had to take a refresher course on algebra. It was really embarrassing. Like, I feel like I'm kind of, I'm smart enough, not the smartest person in the world, but geez Louise. And then I had to take calculus. That was part of my business, program. And oh man, I was so nervous, but I studied hard. I had a good teacher and I got an A in calculus. But that was a long freaking time ago. Look at this gray hair. I don't remember anything about calculus except the concept of what a derivative is. So anyway, if you remember calculus, the mathematician's definition, definition 2, is really just a restatement of definition 1. But it's like a nerdier way to say it. Definition number 3 is the hedger's definition. That is the equivalent of underlying shares represented by an option position. You ever think about it that way? It's a good way to think about it. If you buy one call and it has a 43 delta, it's like owning 43 shares of the stock. Think about it. It's like it as far as how much you will make or lose as the stock goes up or down a little bit. And then definition 4 is the trader's definition, which, see the little footnote there, definition 4 is not necessarily mathematically correct. This trader's definition is included because many traders use it as a rule of thumb. I remember when I was on the trading floor, when I was a clerk or a young trader, and it'd be a Friday, and somebody would come up and say, "Hey, Paz," because that was my badge on the trading floor, PAS. "Hey, Paz, are you going to make it to my party later this evening?" And I'd be like, "Yeah, I don't know. There's about a 50 delta. I'll be there. I got something I got to do first." The likelihood of happening. And that's what us nerdy trading floor people, how we talked. So these are the 4 definitions of delta, and they're all like kind of basically the same. I mean, the first 3 are really just restatements of each other. And the 4th one is not entirely mathematically accurate, but kind of close enough. Now, there's some rules of thumb about delta, and some of the folks here are already familiar with this, as I just learned. It was pointed out to me by Knut that if an option is at the money, it has about a 50 delta. And I got those 2 little wavy lines there. That means about equal to. And I'll talk more about that in a second for the people who already know this and want to split hairs a little bit on this. So if an option, call or put, is in the money, it will have a greater than 50 delta. And the more in the money it has, the closer to 100 delta it'll be. If an option is out of the money, it'll have less than a 50 delta. And the further out of the money it is, the closer to 0 the delta will be. To understand this, let's go back to the not exactly mathematical definition, the trader's definition of delta. It's the likelihood of an option expiring in the money. Well, if an option is already really deep in the money, like say the stock is at 100 and like a couple months ago you bought the 50 call and the stock just rose so much that it's like 50 bucks in the money and like it's expiration day. Well, that has just about 100% chance of expiring in the money if it's that far in the money. Let's go the opposite way. Let's say you bought a call a couple of months ago. You bought the 100 strike call and the stock fell all the way to 50. That call is super out of the money. It's 0 bid and offered at a penny. It's so far out of the money that would have to double. Let's say we're close to expiration, because that kind of matters too. We'll talk more about that in a minute. It would have to double to expire in the money. It's very unlikely, just about a 0% chance of expiring in the money. But if it's right at the money, it's 50-50. Let's say the bell rings to close the markets in 1 minute. It's a 100 strike call and the stock is at 100. Is it going to be in the money? I don't know. We got 1 minute to find out. If it ticks up by a penny, it is. If it ticks down by a penny, it isn't. Now, in fact, if an option is exactly at the money and there is an interest rate and there's, some time to expiration, let's say there's a month to expiration, the delta actually won't be exactly 50. Will it be more than 50 or less than 50? Let's see who's smart. Will it be? Oh, it is Aslan. Oh, wait a minute. It is actually more is the answer for calls. Did I specifically say calls? Because if I didn't, then I goofed up phrasing the question. And a good way to think about that is also considering likelihood of an option expiring in the money, as well as time value of money. Like, let's say there's a company out there and they decide, you know what? business is just too hard. Here's what we're going to do. We're going to sell all our factories. We're going to fire all of our employees. It's just going to be me, the CEO. I'm not going to withdraw a salary. And we're just going to take all the cash that we get from selling all of our assets, and we're going to just buy T-bills. Okay. Well, a year from now, guess what? That company is going to be worth whatever it was worth a year ago, plus the interest that it earned on the T-bills, right? So there is this concept called time value of money. And sort of like the break even, if a company doesn't do well, but doesn't do bad, they just float along, they should make, in theory, this is like financial theory here, they should make the interest rate. And there might be, some other factors there involved. So in the future, companies should theoretically be worth a little bit more. And the higher the interest rate, I got a whole slide on this, but I'll steal my thunder a little bit. The higher the interest rate, the more than 50, the further, the higher the value is above 50 for at the monies. All right, fun stuff, huh? All right, we're drilling down here. We're drilling down. All right. Now, also, there is a call and put relationship. The absolute value, oh, more math terms. What am I trying to do over here? Ruin everybody's day? Talking in more math terms? Absolute value, what does that mean? That's a very simple term. Absolute value just means you take away the plus sign or the negative sign. If it's minus 37, it's just 37. If it's positive 37, it's still just 37. And there's a reason for this. It's because of put call parity, that the absolute value of the call delta plus the absolute value of the put delta equals about 100. That's because from a synthetic standpoint, I think we did a class here at Firstrade on synthetics. Go back and look through some of their YouTube videos. That's where they keep their archives. I think I did a class on synthetics. And because of synthetic relationships and put call parity, that's why that first bullet point is true. Now, it's a little different for American exercise options, which are what equity options are, versus European, which are what index options typically are here in the US. Some things can kind of goof up that first bullet point and goof up the put call parity with American exercise because they can be exercised early, especially when there's dividends involved for calls or when there's a lot of interest involved for puts. But suffice that that's really all we need to talk about on that. We can drill down. I could do a whole day class on delta, but you would want to pull your hair out. Pull your hair right out of your head. Oh, hold on a second here. What the even heck? I gotta move my little circle over. So the call delta is 52, and the put delta is an absolute value of, well, just round it to 48. 52 plus 48 it's about 100, isn't it? And if you think about it, if I bought the 594 calls and I sold the 594 puts on the same instrument in the same expiration, if the stock is above 594, puts expire and the calls get exercised and they become 100 shares. If it's below 594, calls expire and the puts get exercised or get assigned and become long 100 shares. So, I mean, if I buy the call and sell the put, I'm going to have a 100 delta position regardless. So that is a pretty useful little rule of thumb there. Now this is one, like if you really want to get good with the Greeks, and first of all, you probably should just go to Amazon and get my book. And I'll tell you what, If you've never written a book before, I'm not telling you that for my own purposes, because I barely make any money off books. You would be shocked and appalled how much authors make on book sales, book royalties. But I spent a lot of time working on it. It's in its second edition. It was published in simplified Chinese. So that if you really want to get great with the Greeks, do that. But aside from that, this is a pretty good thing to get down. And I'm going to make it seem pretty intuitive, but some things are not going to be intuitive, or you might need a review or reminder. So this is a good one to either write down or take a screenshot or take your camera phone out, and it's a good one to save. As moneyness, time, and volatility change, delta changes. So let's talk about moneyness. What is moneyness? Well, moneyness is a option nerd term for how much in or out of the money an option is. The option strike price relative to the underlying stock price. Gosh, it is pouring rain out here in Chicago. Woke up at like 2 o'clock in the morning and it was lightning and thundering out. You believe that? March, in like a lion, out like a lamb. So delta changes as the stock price goes up or down, right? Because like the strike price obviously stays where it is. That can't change. But the stock price, where the stock price is relative to that strike price, changes tick by tick. So if we're talking about a call, when the stock goes up, the delta gets bigger. The stock goes down, the delta gets smaller because it's getting more out of the money, right? Put, stock goes down, the delta gets bigger as it gets more in the money. Stock goes up, delta gets smaller as it gets more out of the money. That is measured by gamma, which we'll talk about in just a sec. As time passes, in or out of the money option deltas move away from 50 and towards 0 for out of the money and 100 for in the money. Why is that? Well, we actually already talked about it. I'm just saying it a different way. Because let's say that, okay, so let's say we're talking about the 100, there's a stock at 100. No, let's say we're talking about the 100 strike call. And right now, the stock is at 105 and there's 15 seconds left in the day. 100 strike, stock is at 105, so it's in the money by $5 now, and there's 15 seconds left in the day. Stock would have to fall a little more than 5% for those calls to be out of the money. So they would have basically 100 delta. But what if there's 2 years until expiration? You're not going to have 100 delta anymore. You're going to have something a lot smaller than 100 delta. When there's a lot of time, deltas move towards 50 because what's in a binary event, I mean, stocks really aren't a binary event, but I mean, they can go up or they can go down, but there's degrees of it. What is the most uncertain percentage number? 50. 50-50 is a coin flip in a binary event. All right, volatility. An increase in volatility will cause the deltas of all options to tend towards 50. A decrease in volatility will cause all deltas to tend away from 50. Why? What is volatility? Uncertainty, right? I mean, basically, isn't it? What's the most uncertain delta for a single option you can have? 50. When there's more certainty, volatility is lower. If the option's in the money, it's more likely to stay in the money if it doesn't move that much. The option's out of the money, it's more likely to stay out of the money if it doesn't move that much. If it whips around all over, it's closer to 50. Make sense? And then interest. As the interest rate rises at the money call, deltas get bigger and put deltas get smaller. As the interest rate falls, at the money call deltas get smaller and put deltas get bigger. Now, statistically, I know that you probably trade options with less than 30 days to expiration. Now, I also know that's not true for everyone, but that's where the volume is. Most options traded are within a 30-day time frame. In fact, if we look at SPX and SPY that have daily expirations, almost 50% of the volume is 0 day options that expire today. So this interest rate thing doesn't matter for 0 days. It doesn't matter much for week options, 1 week options to expiration. It doesn't matter for 2 weeks, 3 weeks, 4 weeks options. But if we're talking about leaps, the interest rate changing is going to have a big effect on our calls and put deltas. Okay, I mentioned gamma. What's gamma? Gamma is the rate of change of an option's delta given a change in the price of the underlying security. And it's stated in terms of delta. The stock goes, if the gamma is 7, the stock, if it's call, and the stock goes up by $1, the delta goes up by 7. So maybe it goes from 51 to 58 delta. It's greatest for short-term at-the-money options. Long options have a positive gamma and short options have a negative gamma. Positive gamma always helps you. Negative gamma always hurts you. Now let's talk about delta and leverage. Let's say I'm thinking about buying a call. Well, because I think the stock's going to go up. If I'm right and the stock rises, I should make money. But how much? If the stock price falls, I should lose. But how much? So let's explore that here. Okay, so I'm bullish and I'm considering buying a call because this is a short-term trade and I don't have to worry about time decay. Like we say, basically, yeah. So I'm going to buy a call. So here's a question. I know that each call option gives me the right to buy 100 shares. But if I want the exposure of 100 shares, meaning like, hey, if I'm wrong and the stock goes down $5, I don't want to lose more than $500 on this. So if I want the exposure of 100 shares, how many calls do I have to buy? Well, there's 2 considerations, capital outlay and delta. So if I were to buy the stock, which in this case is $185 a share, well, stock has 100 deltas. And we could use definition 3 of delta for that. 100 shares of stock is like owning 100 shares of stock. It acts 100% like itself because it is itself. But if I instead buy the at-the-money call, which we're rounding to a 50 delta, well, how many calls would I have to buy? What if I buy 2 of the 185 calls? Well, if each one costs $2.34 and I buy 2 of them, I'd be paying $4.68. If the delta is 50 and I buy 2 of them, 2 times 50% is 100%. So let's compare stock versus calls again. I buy 100 shares of the stock. So I'm going to pay $18,500. Okay. If the stock goes up $1, I make $100 because I own 100 shares. Stock falls by $1, I lose $100. Now, if I buy 2 185 strike calls, I'm going to pay, like I said, $4.68 a contract. So times 100, that's $468. If the stock rises by $1, I make about $100. If the stock falls by $1, I lose about $100. Who can tell me why I have to qualify this and say about? Anybody tell me that? Why is it about and not exactly $100? It's 50 delta, right? Let's see who the smart folks here are. Somebody gonna beat Oslam again today? Oslam, you got beat earlier today, man. Somebody's like, he's quick and the dead around here. And, you know, just keep the answers short because I don't want to wait around for somebody to type a, you know, a white paper up on it. No? Nobody wants to throw it out there? All right. Well, because of the delta, you will make $100. But as time passes, you lose theta. Volatility goes up or down. You'll make or lose money. Because of gamma, if the stock goes up by $1, my delta gets bigger, so I'm actually going to make more than $1. If the stock falls, my delta is going to get smaller, so I'm going to lose less than $1 in actuality. So that's why that is. And so we can look at this in terms of what this really is it's leverage, right? Delta times the option quantity equals effectively the equivalence of shares of stock as far as directional sensitivity goes. So if I buy if I buy 4 25 delta calls, my profit or loss as the stock goes up or down is going to be like what my profit or loss would be if I owned 100 shares. If I buy 10 30 delta calls, that's like having the exposure of being long 300 shares. If I buy 540 delta calls, that's like the exposure of being long 200 shares. If I buy a bull call spread that has a 26 delta and I buy 10 of those, that's like being long 260 shares. It works for spreads too. Now there's some caveats here. The first one, hey, leverage is a double-edged sword. It's great when you have leverage and the trade works out, but when the trade doesn't work out, man, that stinks. Also, the call is not a perfect substitute for stock, which you kind of already talked about already. Mainly, there's gamma, which from owning a call, you can see how you make more when you're winning and you lose less when you're losing. So it's a benefit either way. And then there's time and volatility and maybe interest, maybe even dividends. Okay, how about puts? Okay, same thing from a bearish standpoint. I'm bearish and I'm going to buy a put. But question is, how many puts do I buy if I want the exposure of 100 shares? Okay. Well, there's two considerations, but they're actually a little different here than the call. Capital outlay versus margin and delta. So it's kind of the same idea here. If I short 100 shares of stock at 185, it's 100 delta. If I buy puts, they're priced at 268, they have a 50 delta. What if I buy 2 185 puts? So each one costs 268. If I buy 2 of them, I'm paying $5.36. The delta is 50. If I buy 2 of them, that's 100% delta. So this is why I have to do a different example for puts because of its difference. If I short 100 shares, how much do I pay? Well, technically, I don't pay anything. In fact, I get paid, right? I actually get cash put into my account. But I've got to post margin on some of that cash. Either way, if the stock falls, I make $1. Stock rises, I lose $1. But there's inherent leverage there. It depends on your broker and your situation, depends on a lot of things. But let's say you have to put up 20% of the value of the stock to short the stock. Okay. But with puts, I do pay something if I buy them. And my risk is defined. If I'm short 100 shares and the stock doubles, holy cow, I'm going to get creamed. If I buy 2 puts to get 100 deltas and the stock doubles, it kind of stinks that I lose what I paid for the put, but it's only 536 bucks. Stock falls, I make about 100 bucks. Stock rises, I lose about 100 bucks for the same reasons we talked about before. And the same idea here. If I buy 425 delta puts, that's like being short 100 shares. If I buy 1030 delta puts, that's like being short 300 shares as far as directional sensitivity goes. By 540 delta puts, like being short 200 shares. I buy a bear put spread with 21 delta. I buy 20 of them. It's a 400. That's like being short 420 deltas. Leverage is a double-edged sword. Put is not a perfect substitute for stock. And it's more complicated than with calls because, I can say with buying stock, I pay this, buying calls, I pay this. With puts and short stock, shorting stock, well, I don't actually pay anything. I get margin moved over to like the margin side of my account. With puts, I pay this much. So it's just, it's not as apples to apples. And then gamma and time passing and volatility affect things. All right, let's talk about options for protection. Have you ever heard the analogy about how options are insurance contracts? Yeah, you've heard it. Okay. Well, the easiest case to understand that, the simplest, though not necessarily always the best strategy, is a protective put. A protective put is when an investor owns shares of stock and then buys puts against it. Is this a bullish or a bearish strategy? Who has an opinion on that? Is owning stock and buying puts a bullish or a bearish strategy? Williams says bullish. Oslam says bullish. Tomas says bullish. And I would agree with all of you. Yes, it is bullish. It's bullish but cautious, right? And we can tell that by looking at a profit and loss diagram of it. This. We still own the stock. And this is the put strike. If the stock is above the put strike at expiration, the put just expires and I'm long the stock. If the stock is below the put strike at expiration, well, I would exercise my put and sell the stock at the higher price, the strike price. So there are some limits of using profit and loss diagrams when it comes to trading or investing. First of all, if you look at how much it costs to buy a put to hedge a position and annualize that, you're probably never going to buy a put, or at least not buy it and hold it to expiration. You might buy it for some shorter term protection, meaning you buy the put and then once the risk you perceive is not valid anymore, you sell the put and just take the residual value of it. So that little hockey stick diagram here like this, you're probably never going to buy a put and hold its expiration. You might. I've done it, but usually not. So we need to use the Greeks, really, is what we need to do. Let's say we want protection for 1 week. Well, what do? Okay. Well, the textbooks say Well, if I own 100 shares of WXYZ stock at 41 and I buy 139 put that has a 30 delta at 90 cents, the insurance analogy that you read in textbooks are, well, it's a $2 deductible because I'm not protected between 41 and 39. But if the stock's below 39 at expiration, then I'm protected and it only cost me 90 cents. So it's really like your deductible is $2, but your premium is 90 cents. So you're kind of stuck for $2.90. So, okay, there are 30 delta puts. In this textbook protective put example, it doesn't really matter what the delta is. But as far as short-term protection, if I just want this for a week because, there's some big event, like, I don't know, for those of you who are watching this live, maybe there's this tariff thing going on right now, right? What if you're thinking, hey, you know what? I think the US and Canada and Mexico are going to wrap up they're going to make deals and these tariffs are going to go away hopefully within a week. I don't know. I mean, I'm not saying that's what I think. I'm just looking for a theoretically real world example. Well, you might buy those same puts and they probably have like a month or so to expiration. You buy longer term because there's less theta. We'll talk about that next week. But you might consider buying 3 of the 39 puts. Why? Because they each have a 30 delta. So 3 times 30 is 90 delta. So that's closer to 100. That means if the stock's at 41, it doesn't matter if it goes through the strike or not. If the stock goes down by $1, you lose $1 on the stock, but you make 90 cents on the puts. So here's kind of how you look at this. The traditional protective put example, I buy 100 shares, I buy 130 delta put. In the short term, before the hockey stick expiration becomes relevant, I still have a bullish position. It's like I own 70 shares of stock. If the stock goes down $1, if I don't account for gamma and other things, I'd lose as much as I would lose if I owned 70 shares. But if I do it this other way, the more non-conventional short-term protected put example, buying 3 puts, 330 delta puts, I own 100 shares, but my 3 puts have a short 90 delta. My delta is pretty flat. It's pretty close to 0. Now, the implications there are this. There's more protection to the downside, but there's less gain to the upside. Remember I said leverage is a double-edged sword? Well, hedging dulls both edges, I guess. I just made that up. That's pretty good, isn't it? Hedging dulls both of the edges, less gain to the upside. It's a near delta neutral position. So a big implication here is we need to really manage the risk of the position. And, after a week passes, if the tariff thing is wrapped up in a favorable sense, close the position. If, Justin Trudeau says, we're never going to compromise, like a week from now, he says, we're never going to compromise. Well, then that's wrapped up too. Your puts are going to serve you. But then the market would fall and you would want to sell the puts and capture the profit on the puts before they have time for time decay to work their evil magic on it. More implications. So there's less overall directional exposure, but there's 3 times the volatility risk, 3 times the time decay risk. Those are topics for the next 2 weeks here at Firstrade. And you've definitely got to manage the trades a little better. You would not want to hold these all the way till expiration because you lose 3 times as much because you're paying 3 times as much. All right. One other thing I want to talk about here is netting deltas. So let's say we go to options. Let's pull up spiders. Spiders. And let's go to the Greeks / analytical chain type. Look at the March 12th expiration just randomly. What if I bought, these are calls on this side. What if I bought the 579 calls and sold the 583 calls? I did that bull call spread. What would my delta of that bull call spread be? Well, you just break it down in its legs and add them together. I'd be getting long, and we're just going to round this to two decimal places. You'd be long 50 deltas, right? And you'd be short 41 deltas. So you'd be long 9 deltas. What if I did a bull put spread? Like I sold the 577 puts that have a 46 delta, bought the 574 puts that have a 40 delta. Well, 40, I'm getting, okay, so if I'm selling these, I'm getting long 46, buying these, I'm getting short 40, so I'm getting long 6 deltas. Oslam asks for a butterfly. Do we calculate the same way? Yes. So let's look at one of those examples. Butterfly. I like butterflies with just a couple of days to expiration. Let's look at Friday's butterfly. Let's say I buy the $575, $578, $581. Yeah. Well, I'd get long 59 deltas, and then I'd get short 51 times 2 is 102. So calculator. I bought this calculator when I bought this calculator in the early 90s and it still works. So if I'm buying the 575 calls, I'm getting long 59 deltas minus if I'm selling 2 of the 578 calls, so minus 102, and then I'm getting long 1 of the 581 calls at 43 delta plus 43. My delta is literally exactly 0 on that. Wow, huh? So this becomes pretty powerful because if it's 0 delta, and if I have negative gamma, which I know always hurts me, and I have risk to the upside and the downside, I know that I kind of want to stay right at 78 because my negative gamma will give me long deltas if the stock goes down, short deltas if the stock goes up on a butterfly. So using that delta for this, it's really, really powerful. How about this? So this is SPY, right? What if I buy, like I buy a 10 lot here. Okay, hey, I think spiders is going to go up. I'm going to buy some calls. How many calls should I buy? I don't know. I usually trade 10 lots. I'll buy 10 lots. Well, that's like buying 514 shares of spiders. If you buy 514 times, what's the value of spiders right now? 578? 514 shares times $578. That is what we call a dollar delta. That's like if you buy 10 of those calls, that's like being long $297,000 worth of stock or worth of shares of spiders. Would you be comfortable paying $297,000 of spiders right now? Because if you're not, you sure got no business buying 10 of those calls, because that's the exposure you have. So all this, the reason why we have the Greeks is to help us manage our risk better, to help us understand better what our risk is, and to trade in a smarter way, to get leverage that we want, but not get too much, not get more leverage than we want, because we're just thinking of how many lots we trade instead of what that actually implies. Canute, my apology. Is this recorded? I lost some of the presentation. Yeah. Shortly, I'm not sure exactly how long it takes them, but Firstrade will put this up on their YouTube channel. So I don't know, maybe by tomorrow. I don't know how long it takes, but just go to YouTube. Thank you. Just go to YouTube and search for Firstrade. It's all one word and there's just one T. So it's not First Trade. It's Firstrade. One T only in the middle there. Do we have any final questions before we call it a day here, friends? Any final questions before we call it a day here, friends? No? All right, then. It is a day. And next week will be a day also of education, at least for an hour. And I will see you on March 11th when we talk understanding the Greeks' theta, the role of time decay. Smita, you're welcome. Aslam, you're welcome. Catch you next time. Trade smart. Ciao.